Hello, here's what's moving the markets. Poor non-farm payrolls data increases the probability of a rate cut by the Fed. The US drops tariffs for Mexico, and UK politics will be in focus this week. The trading week has begun with a strong risk appetite after the weak jobs report in the US, which took place on Friday and has increased the expectations of the Federal Reserve rate cut in July. Japan's GDP growth had beat analyst expectations, and Chinese exports rose 1.1% in May despite the escalating trade war scenario. Chinese trade balance had improved in May due to an unexpected rise in exports and a decline of 8.5% of imports. Asian equities traded in the green, while safe haven currencies and gold weakened. The US economy added 75,000 non-farm jobs in May, far below 175,000 expected by analysts and 263,000 printed a month earlier. The average hourly earnings stagnated at 0.2% month on month versus 0.3% expected. The soft data came after the Fed Governor Jerome Powell said that the Fed could cut rates if necessary to give support to the US economy. Markets clearly believe that a rate cut is necessary. The probability of a July rate cut surged to 80%, according to the activity on US sovereign bonds. The US 10-year yield is testing the 2% level for the first time since September 2017. So bad economic news has been good news for the equity markets. The US stock indexes recorded a strong weekly close. Looking ahead to the remainder of the week, the most impactful data release is likely to be Wednesday's US CPI data for May. With markets continuing to ratchet up bets on the Fed cutting rates, a softer than expected pace of price increase would likely further weigh on the dollar and increase pressure on the FOMC as well. Markets expect core CPI at 2.1% on a year-on-year basis, unchanged from the previous release. Other notable releases include labour market reports from the UK and Australia, in addition to retail sales and consumer sentiment figures from the US. Away from data releases, it is set to be a relatively quiet week for central banks, with only the Swiss National Bank due to announce a policy decision. So markets expect rates to be kept on hold, with a rate hike this cycle having been made even more unlikely after the ECB's dovish tone from last week. So negative rates look set to become the new normal in Switzerland. So with a further loosening of policy, especially further down the line, not out of the question, that is what is going to be the focus. The UK is going to be a dominant focus as the Conservative Party begin to look for Theresa May's successor. The UK should be in the area to watch for geopolitical risks. So have a good trading week. Thank you.